Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 19th, 2019. A couple housekeeping items before we get started here. I just want to mention that we'll continue to have some changes going through the site this week. Any outages at this point should be temporary, if at all. You should be able to access the site. There's a little message on the new login page that you might have something about cookies. That we'll get rid of that soon. I'm working with a team of developers, and I've been consumed with this project over the weekend. I waited to the 3-day weekend to do most of the changes, although they'll do a lot of the nitty gritty work. Most of the the changes that I want to do, I need to go in and start working on those myself, and and then hit a wall and then steer it to the programmers to like finish out a project. So I have no less than 40 hours over this weekend alone, and that pales to what I did over the last week or so preparing for this. So I wanted to say that I'm behind on notifications, I'm behind on the updates, but remember, on the official trades, if I don't post an update in advance, a profit target or a stop is the stop on that official trade. But remember, those are just suggested stops, suggested price targets. I have a lot of traders that say they use their own stops. They'll take the trade ideas, they take what they like out of it. Maybe they revise, take a different entry. Maybe they use different targets. And, I recommend do that yourself. And I also talked about this market being volatile recently. A lot of stop pops over well placed levels, and so in a lot of these trades, it'll help if you can do a 60-minute candlestick close above a certain stop point or below a certain stop point, and in some cases a daily close. But I'm not adding that to the official trades lately. It leads to a lot of confusion. People that don't have the luxury of being in front of the computer. There is not, that I'm aware of, an automated system with any trading platform that will calculate that for you. It's just something you manually have to watch. So you let a stock, go above a target in, a certain level, and then at the end of that 60-minute candlestick period, if it's still above that level, that's where you close out. All right, so let's get into the charts, and we'll look at a few examples on that. But before we do, I think this is the most important thing right now I want to talk about. There's a lot of a lot of buzz in the trading room. Traders that are basically say they're feeling a lot of pain. They're uncomfortable. They're in the in some of the index shorts, whether it's the official QQQ short trade or they shorted SPY or IWM or something else, and are very concerned. And at this point, want to know where to stop out being underwater. And I wanted to talk about that a little bit. It ties into what I'm working on. One of the things I rolled out last week, a new feature on the site, is the position size calculator. And with that, right now, you can plug in what your average typical position size is. It'll come up with you plug in your price targets, your stop loss, and it'll come up with the risk reward ratio, how many shares you need to buy. I did add that feature to it just recently. And one other feature that I will be adding to that as soon as possible, hopefully get to that this week, no later than next, is another feature at the top. I may add it as a toggle wherein you enter your total portfolio size and the percentage of your portfolio you're willing to risk on each trade, because this is critical. And I'm suspecting that anybody who is feeling pain right now on a QQQ short trade that they entered any time, unless they took that back here. And again, people do their own analysis. They supplement their analysis with mine, but I was adamant, even leading down into the lows, that the risk reward was not favorable. And then, once we saw the reversal come, consistently and persistently bullish, even on that first pullback and dip, and it didn't start getting bearish to right about here. And let me show you that. I'm going to go over something here on the chart. Before I do, I'll go over to QQQ in a second here. This is what I'm trying to get at here. The bulk of the gains came very early on. Here's the lows back here, and we're looking again at the futures. There's the lows when the market bottomed, and you can see up to this point, which was right around January, I think January 18th or so. I'll put a crosshair on it in a second. The bulk of the gains were made. Since that point, here's what the market's done, and I'm going to show you right now in percentage terms. So again, here's the bulk of the gains early on, and the market it's gone up, but relatively speaking, again, guys, relatively speaking, it has hardly moved. So anybody that shorted back here, and that's somewhere in here is where we, or at least I, put on the first official QQQ short trade. Um, and since then, let's see, since the market peaked, these lines that I put here measure 3.89. We'll call this 4%. So right here, I have a line. It's about 4%. And again, that was about January 18th up until now. This is QQQ, or the NASDAQ futures, have only gained 4%. If anybody shorted in this range and they're feeling pain with them on a NIG short that's up 4%, most likely it's because you took a leveraged ETF, one of the two, maybe 3-time leveraged ETFs, and or if it's a raw short on QQQ or the futures, you took a very oversized position relative to what your portfolio is. So you can see the line right here off the lows. The market gained about, the QQQ is about 17%, a little over 17%, we'll call it 17. So 17% in the first, what is that, about 3 weeks. And then since that point, which is now going on over a month, we're talking about 4%. So this is, again, it all comes back to position sizing. Again, if somebody was unfortunate enough to short down here, or here somewhere, yeah, you should be feeling pain. That's a pretty nice lift. But again, most of the lift stopped right here at this point. You can see we had a sideways, sideways trading, a pullback actually from that point. Traded sideways, broke above that range and came back in, and we've been trading in another range since. Again, about 4% off that point. So now let's look at QQQ. Let me pull up a chart here. All right, QQQ, let's go to a 60-minute chart, and I put a marker on where that first QQQ short trade on the site came January 18th at 164.97. So we'll call that 165. If I can grab that number, I've got to go a little bit lower, a little bit lower. That's close enough, 164.98, almost perfect. So from that point, again, that's the entry on the first QQQ short trade. And, after we got stopped out, clipped on that one, I extended it. There it is. The market's up right now, as of today, about 4%, a little over 4% from that point. That wasn't too far off that initial high right there that I just showed you on the futures, which came again on the January 18th. All right, so again, I truly feel for those that are feeling pain, and the old adage on Wall Street is sell down to the point at which you can sleep at night. Nothing has really changed in my outlook. There's certainly been some breakdowns that didn't pan out, some technical developments that didn't, and I'm not going to spin this any other way, but that I was wrong in this point on the extent of the pullback that I was looking for. But that doesn't change going forward. In other words, I don't stop believing in technical analysis and the same tools that have worked for many years. And as I always say, nothing, absolutely nothing is 100% in trading or investing. Even the best looking chart patterns sometimes don't pan out. Sometimes technical patterns are overridden by fundamentals. And I'm just a firm believer. If I wasn't reading the tea leaves right at this point, so it's not something to do with the all-powerful Fed. I anticipated the Fed moving from a hawkish tone back here to a dovish tone here, and that happened, and that's being cited right now in large part for the reason for this rally is that the Fed has shifted from pulled a 180 on their stance. But again, so we'll talk a little bit more about this going forward. I will add that position size calculator. Again, it'll have either a separate calculator up towards the top. You'll enter your total portfolio value in dollars, the amount that you want to risk on each trade. There is no set in stone rule of thumb on that, or set rule that is. But for the most part, let's just say around 2%. Some people do a little more, some a little less. 2% of your total portfolio being risked on a trade. And I'm talking about swing trading here, not investing. This is swing trading. And I'll do a write-up on that as well. So if you risk 2% of your portfolio on a trade, the calculator will tell you where your stop should be. You tell it what you want to buy, what the entry price is, and it will then suggest a position size and a stop. So if you have a $10,000 portfolio, you lose $200 on a trade. If you have a $100,000 portfolio, you can take a $2,000 loss on a trade. But if you're risking 10% on a trade, let's go back to a $10,000 portfolio, and you lose 10%, you're down to $9,000. You do that on a few more trades, you will be out of business. And the reason is, it's the way math can be cruel when trading or investing. And the reason is, when you have a loss, let's say you take a 50% loss on a security or your portfolio, guess what? You don't have to make 50% on the next trade to get back to where you were. You have to make 100% on the next trade. That's how math works. 10,000 goes down to $5,000. Now you have to double your account just to get back to where you were. So, and that ratio, it gets more extreme the bigger the losses. That's why you want to keep them small. And again, factor in the leverage on these leverage ETFs, diversify. And, when the market is not very conducive to trading, keep the position sizes on the light side. That would be my suggestion. Again, I'll do a complete write-up, and I'll modify that stock position size calculator, and I'll make a post once it's complete there. Okay, and since we're on QQQ, let's just take a look at it. Since last week, I've revised. This is a trend line I've been watching, and I'm sure a lot of eyes are on it. It's a trend line off the lows. Again, this is how it looks on the 60-minute chart. But there's a trend line that I think at this point in time is more significant. And it's also, I like to call it a BOD, benefit of the doubt trend line, because it comes in slightly lower. You don't really see it here. I'll show it to you on the futures. But on QQQ and on SPY, or ES, it's the initial, that trend line starts off the initial pullback that we had. Remember, the markets bottomed on Christmas Eve, abbreviated trading day. We had the big rally on the 26th when they opened. There was a little pullback there, but I like it because we have more reactions. In my opinion, that's where I give the higher weighting to a trend line. The more reactions you have, the higher the weighting is. And this one has quite a few, and I'll show it to you again on the futures in a second. Now, they come in very close. So one breaks, the other's probably going to break, and I can guarantee there's probably more traders watching this one off the lows there than this one. But again, this market's been extremely resilient. It's had some whipsaws. A lot of these short-term, minor trend line breakdowns have played out for little pullbacks, but this is a bigger picture. And again, nothing's changed in the technicals. Sooner or later, we're going to see a sizable correction. And right now, this is a very one-sided trade. It has blown out a lot of short interest, undoubtedly. I don't even have to look at the numbers. They're dated anyways. Anytime you look at short interest data, they only report it bi-monthly. It's twice a month. And even then, there's I believe an 11-day lag time between the actual date where the numbers were taken to the dissemination date when it was released to the public. So that's basically useless information in a fast-moving market. For years, I've always had to try to extrapolate, and you can do a pretty good job. You can look at charts, see what levels probably cleared out, popped a lot of stops on shorts. And so I think it's safe to say that short interest has dropped off in recent weeks. And what that means, it just sets the stage for a more swift drop. When you don't have the shorts in there to cover, like you do on these little pullbacks, what happens is the longs start selling, and there's nobody to take the other side of the trade. When you have a high short interest on a stock or an index, you have shorts taking profits on the way down. Since when you clear out a lot of that short interest, that's when you get the quick move. So I'm still very much open to a pullback to these targets. Let's look at the official QQQ short trade, and we'll move over to SPY. The QQQ short trade, here it is. So they popped the stop on Friday, and again, I've been consumed with a lot of these changes. These stops, I stick with the official stops, whether the trade goes on to plan out or not. There's never been a trade that's run a stop. If I didn't modify that stop in advance on a front page post for all members to see, then it is considered stopped out. Now, whether you want to hold on to it or not, that's up to you. I mentioned in the trading room last night, I'm still catching up on replies. A couple strategies as to, if you're feeling the pain at this point, and I get that. And it doesn't matter what I said earlier. It doesn't matter what I, say how, I still can make a case for a decent correction. It will come, and it's just a matter of how much more it's going to go up. Remember, you can always enter a trade if you get that objective entry, but you have to at some point, especially if you've taken a large size, you have to protect your portfolio. And there are no guarantees that this market will correct very soon. Anything is possible. I've learned that over the years, that absolutely anything is possible. So it's pushed up without a decent pullback to this point, and it could certainly do so again. I don't think that's going to be the case, but again, we have to see right now. These are the levels I'm watching. I would put good odds. I put some good odds on the last couple breakdowns, and those odds didn't pan out. And that's just statistics, probability, and calculated risks that we take. But these trend lines here, they're more developed now than they were. More reactions, more valid. You have clean, divergence here. It's not yet confirmed, but we need to see the PPO turn down. And again, watch out for a breakdown there. Watch for a big red candle. That would be impulsive. And then watch those futures. Even if you don't trade the futures, investing.com will give you free futures accounts. You can create an account and save your annotations on the charts. They're real time. And then you can replicate the same trend lines. And it might give you a little heads up or a little additional confirmation, because right now you have to give this market the benefit of the doubt when shorting. SPY looks like a Christmas tree of different colors, just trying to distinguish each trend line. Here's that comparable trend line on SPY, and I'll get to ES. I'll jump back to the futures because we looked at NQ before. Well, we have the white trend line off the lows right there, and that's hugging prices. It's certainly, both are valid trend lines, don't get me wrong. I wouldn't have the trend lines on the charts if I didn't think they were significant. And the thing about technical analysis and trading is you have to look at, and I do this with moving averages too and trend lines, support levels, what are other traders watching? And really where the majority eyes fall, that's going to be the trend line that matters. But in a tough market like this to short, and again, you're not making, from as I said, going back to January 18th, it's not like it's been a runaway market. We're talking a 4% lift in the NASDAQ over a month. And, sure, in any given month, that's good. But relative to the big move down we just had, we were having, back in the fourth quarter, we were going down 4% a day or having intraday price swings of 4% a day almost on a regular basis. So again, right now volatility has been abating as we move up, and that's why these momentum indicators are rolling over. The steepness of this advance is declining. We haven't gone down yet, but it's not the sharp up it was in the beginning. It's sort of leveling out here, and that just shows that this rally is losing momentum. Okay, and ES, I might cap this video up once we finish the indexes. I'll try to get to IWM. I'm looking at the time on the clock, and we'll keep this one short. Maybe I'll break it down and do the other trade ideas in another video. Here's that comparable trend line on ES, the S&P 500 E-mini futures. And I did post a chart on this last night. I believe both of these are on the front page. You can see 1, 2, 3, 4 reactions on that trend line, where we had at least 5 on the NQ. Same story, we continue to diverge, and we have little micro divergences, bullish and bearish within. Each of those lead to little rallies within the bigger uptrend. So that's the the intermediate term picture right here. Not long term, but the intermediate term picture or intermediate term trend is bullish, and so we have these little micro corrections and rallies within the larger trend. But right now, I believe these trend lines are defining this uptrend, and a break of those, again, you want to see it happen on ES, you want to see it happen on NQ, and QQQ and SPY as well. That will most likely trigger the correction. And, targets remain, as I've talked about before. Here, I'll jump back to NQ if I didn't, or QQQ if I didn't do that already. Here's SPY. Let's just say rolling targets right now. Let's see when the breakdown comes. Let's see how it looks. But at bare minimum, you can see some lines that I have here on the chart. Bare minimum, I think we come down here to that 265.55 level. And to try to quantify it for you, that would be a drop of about excuse me, 4%. There's a minor support level here that's probably going to come into play first. So I'll give you that number. It's about 273. Let's round it off. People like round numbers. And then down there, and I do think there's a good chance that before all is said and done, based on everything, um, we could come down here. And now these would be, let's just say this is my bullish scenario. Um, the more bullish scenario that I have, a range anywhere from that 265.55 target down here to 258.90. And as you know, there's still sufficient evidence, not rock solid, but sufficient evidence with the long-term trend indicators, long-term breakdowns, that this is still a bear market rally, despite what everyone says. I'd love to get to that. I'll do a post on that. Actually, I'm not going to waste time in this video because I don't have the chart annotated already. But I had a little chuckle on Friday. Of all sources, a Wall Street Journal sent out an article that said, something to the fact that the bear market in the Nasdaq is now over. It's officially over. They declared it over because the Nasdaq had rallied 20%. And it reminds me of those, if you've traded or invested for a while, you're probably familiar with there's some famous magazine covers, Time, Newsweek, that declare, either a bull market will continue for a long time, and those come out right at the top, or, maybe have a correction like we just had, and they, on the rally, they declare that the worst is over, the market's going to new highs. Well, anyways, what I was trying to get at is I'll put up a long-term chart, and I'll go back 20 years, and I did it, and I measured in every single rally, first initial counter trend rally after the first leg down of a bear market, without fail, exceeded 20%. So you have to look at the bigger picture. People get tied up in numbers. 20% drop. Okay, did we have a bear market last fall? Technically speaking, yes, because we just went down over 20%. To me, you look at the long-term charts, it's just a correction in an ongoing bull market. You know what I'm talking about, I think, when you look at the long-term chart. Okay, so you're going to tell me this is a bear market and that's not, or that's not. No, this is a bull market. And at this point in time, all we can say is that's a correction. Time will tell if it is the initial counter trend bounce within a new bear market. I still suspect that it is. There's sufficient evidence to say that most likely it is. But as I've done in recent videos, some of the long-term videos, there are some long-term trend indicators and some long-term trend lines or key support levels, as well as some key market-leading stocks that just came to the very edge, tested those levels of support or those trend indicators and successfully held them. So while a lot did break down and are still below there and are on long-term sell signals, we don't have every index and all the leading stocks, or the majority of them, on those sell signals yet. So it's still anybody's game right here. Now, here's one example. I was going to get to the shorter term charts, IWM, and wrap this video up. But here's a long-term trend line. It goes back, but it's to the left of the chart, at least back into 2009. Lots of reactions. And again, as I say, the more reactions on the trend line, in my opinion, the more valid it is. So there's an example. Then this is not the market-leading index. This is the Russell 2000 small cap index. The 2,000 companies in here, if you add up all their market cap, it pales in comparison to just the 500 or even the 100 in the NASDAQ 100 index, or the S&P, the 500 in the S&P 500. So IWM doesn't dictate where the U.S. stock market goes, but it is a component there. If you look at the entire stock market, small, mid cap, large caps, it is a part of it, and it shows that this index came and tested a long-term primary bull market uptrend line that it hadn't tested in a while, and successfully defended it with an impulsive move off. So, the million-dollar question is, how much longer does this bull market go? Sooner or later, it's going to break. For every bull market, you have a bear market. That is just an immutable fact. It's something that will happen. And the question is, when will it happen? So one of these trend line breaks will prove to be fleeting, the bounce off it, and then you'll go on to break it. And so when you see more more and more of these, other obscure, smaller, lesser known indexes or not as significant indexes break down, and you see a majority of the market leading stocks, and you can see just about every long-term trend indicator on the S&P 500, NASDAQ, rollover, all the support levels break. Then you know that we're probably in the early stages of bear market. I'm going to tell you this now. It's not going to come. You're not going to have that green light, so to call it, until we've probably fallen about another 20% from where we're at right now. Maybe a little less because the trend line's coming a little higher, but I'd say 15, a good maybe 15-20%, and that's about my target. My next downside target on the market. I think the S&P 500. I'm getting a little bit off topic here, but again, we're talking long-term targets and where we're likely going. Somebody did ask me in the trading room the other day. I thought I had a chart marked up here for it. Let's look at the SPY daily. No. Oh, here we go. I'll just draw it off here on this board. This is a 10-year weekly chart of the SPY. That's a long-term trend line. Goes back to the 2009 lows right off the bottom there. You can't see it's to the left of the chart. But I can tell you this. This is a very logical and likely target for the next bear market. And let's just call it at this point in time let's just say a minimum swing target or trend target. Could be worse than that, but we'll see. But right now, I think there's a lot of that's just a natural level for the markets to want to come back and test at some point. There was almost 2 years, a year and a half or more of consolidation right there, sideways consolidation. And you can see the primary trend line is broken. We're still well below that trend line. And this is the bigger picture. If you can take a look at the bigger picture, this is what's formulating, my long-term analysis. We're not even close to, we already backtested that trend line. We're below it. And of course, the momentum indicators are pointing up as they should. On the daily chart, we had divergence here. So again, the rally, this is everything that was expected off that December 24th low, a sharp rally. And again, it's certainly taken the upper end of where I'd expect without a big pullback so far. But this is normal. You have a low-level bullish PPO crossover, and you can see what would happen. And this is sort of how my scenario would play out. The more bearish of the two scenarios, again, assuming the market does not go on to take out the 2016 or 2018 highs. Excuse me. So we'd reverse soon. Come on down to about 214 on SPY. So you can see these trend indicators are clearly down in bearish territory as they were back here. You cross down below zero. You see that signal line, the 9 EMA I like to use, came and back tested at the zero line when everyone thought we were going to new highs, and then boom, the next leg down came. That put in a divergent low on the weekly, at least on the PPI. You didn't have it here, or I should say the RSI. Made a slightly lower low on the PPO, and then that's where you bottomed, and that's what I'm leaning towards right now. So that would take us down. That's about a 20-something% drop down to 214 from where we're at right now, and come down here and put in a divergent low, and then position for a nice multi-month swing trade that could last for more than just a month and a half or whatever this one's done, 2 months. And here's IWM on the 60-minute chart. You can see the trend line off the lows. We broke it there, had a correction pullback. If I extend that trend line, by the way, it comes in with this minor uptrend line right here and forms a perfect parallel channel. So that seems to be what IWM's walking up for. So we don't have any buy signals. Break of this minor trend line would trigger buy signal, but you'd want to again see that confirmed with both the S&P 500 and NASDAQ also breaking down at the time. So watch those futures charts, watch QQQ, and you can see targets down here. There's my minimum target right there. I should add another one. Let's clarify here. Minimum, if somehow they buy this one up, the next breakdown aggressively, I think about 155, 150, 155. There's a nice gap there and a reaction high to target. So that would be about a 3.5% drop. But I'd favor a move down here to about 147.60. You're talking a pretty nice drop because small caps have really gotten ahead of themselves on this rally here. That's about we'll call it now, about 5.9, almost 6%. And again, these would be, I gave you sort of what I call my maximum downside targets for my bullish scenario. And that's down here. That's if this market's going to new highs. Would be down here. It shouldn't really violate that level if we are going up to new highs. Anything's possible, but right now that's where I'd be looking. I'll tell you, I'd like to throw up some Fibonacci's too and study this a little more. So let's just call these tentative targets now. If we start to break down, get some traction to the downside, I'll firm this up and like always do some updates. But there it is. But we continue to diverge. You can see the PPO making lower highs. And that's about it. And I showed you the longer term chart on IWM with long term support. That's certainly a level to watch for if we come down and visit that level again. And finally, we'll just look at IWM daily chart. Yeah, this is the big picture. We had again the correction was priced in. And these divergences work. We had the divergent high. Such this chart's been shared over the years, negative divergence, another divergent high. And again, it's not the divergences that are your sell signal. It's some type of break. Sometimes you'll get on a 60-minute time frame, sometimes here on the daily. Even better when you get on the daily and you can see the corrections that come after the divergent highs. And so this one just continued to wedge on up, but in that last divergent high. And finally, that's the one that really stuck and played out because you had a pretty close series of consecutive divergent highs. Though that's what really does the market in when you have the little divergent highs and people become complacent. Okay, well, you get these little corrections. They're just buying ops. But when you continue to diverge in rapid succession like that, I know this is a 2-year time frame here we're looking at, but again, and then the weekly charts really kicked in. That's what you had the divergence on the weekly charts, and it played out for that huge drop on the IWM. Now, as impressive as a rally in IWM has been, and there's no knocking the vigor of the rally. I'm trying to grab this high right here. Remember, IWM fell, what is that, almost 28% in just less than 4 months, 28% drop. And so as stellar as this rally seems, it's only retraced about 2/3 of that drop. Here's Fibonacci retracements, and we're just trading right slightly above the 61.8. So less than a 2/3 retracement so far off that high. So that's small caps still have a way to go. And although anything's possible, the likelihood of seeing a rally like this continue at the same rate of ascent is very, very unlikely. In fact, usually when you have these near vertical rips, just like a near vertical dip, the ensuing reaction, at least the correction, will be pretty sharp. The steeper the trend line and the more extended you get, overbought you get, usually the sharper the correction when it comes. So I can tell you just looking at this daily chart, not focusing on all those micro levels I just showed you on the 60-minute chart, I would expect IWM's probably coming down here at about 145, and that would be there's a healthy drop if we get it. I know right now it seems like stocks are, bulletproof, but that's close to an 8% drop if it comes. So if you can get the timing right on that one, you start to get those sell signals. You have a position, maybe you want to add to it, set a stop, wherever the top comes, set a pretty tight stop once you see that trade pan out. Maybe trail your stops down, and you might have a nice swing opportunity in IWM. And just looking at that, you can see it looks like if it does pan out like that, it would set up an inverse head and shoulders pattern. But we'll just have to watch that. Let's see. This really, IHS should come after a bear market or a prolonged downtrend, not a correction. So it really doesn't fit with where it needs to be. But symmetry-wise, I just wanted to point that out. All right, I'm going to wrap it up here, and I will continue on updating the other trade ideas. I'll do a video talk on those and try to get to, as soon as I can, move them out on the front page to the completed trades section. And like always, if I see another objective entry, they will be back as official trades. And if you're in those trades and you want an updated chart, by all means, that's what the gold membership is about. I'm in the trading room. I'm a little behind on posts now, but I'll get back to your questions and your thoughts and post some charts on any trades that you want. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.